What is a subdivision bond? Subdivision bonds are a type of surety bond that protect a municipality from financial harm if a developer fails to complete public infrastructure related to a subdivision project. Still confused? Then let's break it down even further. A subdivision is a piece of a larger plot of land that has been divided down into a smaller section, making it easier to sell or develop. Developers seeking to sell these subdivisions before having completed public infrastructure items such as streets, sidewalks, and drains will be required to purchase a subdivision bond. Subdivision bonds are most often required for residential developers. So what exactly is the purpose of a subdivision bond? These bonds are intended to benefit the developer, the municipality, and the land buyer. These bonds allow developers to sell lots of land before the completion of public improvements, increasing cash flow to the developer and preventing damage to the improvements while the construction process is ongoing. On the other hand, the government and home buyers are provided with a guarantee that the necessary government services, i.e., adequate streets, flood control, street signs, and sidewalks, will be completed. So, what questions should insurance agents ask their customers before issuing them a subdivision bond? The first question that should be asked is, are you the developer? Subdivision bonds are required for developers, not contractors. If your customer is a contractor, they will most likely need a different type of surety bond. The next question that should be asked is, how are you funding the project? Developers will need to provide proof that they have the funds available to complete their proposed project. Next, insurance agents should ask the developer what is their largest project that they have completed. Developers who have previously completed projects of a similar size will have an easier time obtaining a subdivision bond. Insurance agents should then ask the developer when is the expected completion date. Projects lasting 2 years or less will be considered less risky, and the developer would be more likely to obtain a subdivision bond. Finally, an insurance agent should ask the developer what specific types of improvements are needed. Underwriters will want to review the project details and the type of work the government is requiring. This information is usually shown on the site plan and the engineer's estimate. Surety companies will also want to examine the following items: the developer's personal credit score, the developer's experience, the developer's financial statements and source of project funding, and the ownership structure of the development company. So how much do these bonds cost anyway? Subdivision bonds will cost 3% of the bond amount each year and will need to be renewed until the project is completed. For example, developers will pay $30,000 in premium for a $1 million subdivision bond. If the project is still ongoing after the first year, another $30,000 in premium will be due each year until the city or county provides a letter releasing the bond. So how can an insurance agent obtain a subdivision bond for their customer? Bond exchange makes obtaining a subdivision bond easy. Insurance agents need to simply log into their account and search our database using the keyword subdivision to find their bond. Don't have a login? Enroll now by going to bondexchange.com and clicking on that big blue Get a Login button, and let us help you satisfy your customers' needs.